Hello and welcome. This is Agam Vakil representing BQ Prime, and we are on the sidelines of the JP Morgan India Investor Summit. Well, we're taking stock of the consumption sector in India, how things have panned out over the previous few months, and what we can expect going forward. And for that, we are in conversation with Latika Chopra. She is the Executive Director and leads consumption research for JP Morgan. Latika, thanks for joining in and taking the time out for us. Latika, I'm going to start off with the question that everyone has on their minds with respect to the consumption volumes at the moment. We've seen a little bit of an improvement in the quarter gone by. The question really is that are we expecting a little bit of an arrest when it comes to decline in volumes? That's the first question. The second one to that is that when can we actually see a meaningful increase in volumes, even keeping the low base aside? What's the way forward from here?
Thank you, Agam, for inviting me to your show. Yes, the Indian FMCG consumption has seen quite a dichotomy, where the mass consumption has been really impacted on account of inflationary pressures. And a lot of that is being driven by rural weakness. And after 5 quarters of rural volumes actually declining, we have now started to see this moving into the positive zone in the June quarter. We still feel that things are a little uncertain here, but nevertheless, we are hoping that this little improvement gradually strengthens as we go into the coming quarters. And what is going to drive this, in our view, is going to be, moderating pricing for the consumer goods. Clearly, we are seeing companies proactively reducing prices in certain categories, whether it's soaps, laundry, shampoos, edible oils, tea, of course, in the rest of the categories, the pricing growth has stopped. Rather, in most of the categories, we are going to start anniversarizing on that front. And this should spur, volume growth to recover. That's first part of it. And the second part is that the companies themselves are getting more aggressive on advertising and promotions, which is going to basically also aid improving volume growth. So for the leading FMCG companies, which were kind of clocking, flat to low single-digit volume growth, we anticipate this volume growth momentum will gradually gravitate towards mid-single-digit volume growth in the second half of this fiscal year, and that's where we are building in our base case scenario. But I should point out, this is going to be a very gradual recovery. Consumer behavior changes do take a lot of time to really play out, and hence, it's not that things are going to be booming, but definitely trying to get better at the margin.
Right. Fair enough. So based on that, what is your assessment, one, currently on input inflation? And with regards to that, the product pricing at the moment, you said that there has not been too much in terms of inflation in the product pricing and the impact on margins and profitability.
Yes, so I think one positive thing that the sector is witnessing, thankfully, is that gross margin momentum is moving in the right direction. Rather, I think in some of the cases, even tracking better than what we were expecting, because companies have started to use the low-cost inventories. So after gross margins taking a big hit much of last year, we are starting to see gross margin build-up really playing out sequentially for nearly every company. Though part of these gains are being reinvested in higher brand spends and marketing spends and some of the promotional spends. But nevertheless, EBITDA margin is also on a recovery path. I think as of now, companies are in a comfortable space. I think for another quarter or two, they still have low-cost, commodity covers, which they can work with. But of course, one needs to keep their eye on, commodity inflation as always. So, crude prices, which have firmed up recently, if they flare up meaningfully from current levels, I think that will be another conversation that we'll be having a few months down the line. And if it sustains at those levels, companies might be forced to, take a rethink on pricing. But as of now, I think we are in a relatively more comfortable zone on gross margin front. EBITDA margin are also recovering. We are not yet back to pre-pandemic levels on EBITDA margin front. And our view is that, we kind of anticipating that to kind of come through in FY25.
Right. Another question that's on a lot of investors' minds is that when it comes to rural wages, they still seem subdued at the moment. We have seen an erratic monsoon, not exactly playing out a script. And based on that, what is your assessment of the rural economy, especially given that we are going into election year, so we're likely to see an increased government expenditure coming through?
Yes. So, clearly uneven monsoon this time, has emerged as a risk. After a rainy July and a dry August,
Right.
September rains have revived. And the monsoon deficit as we speak stands at about 6% versus, where we started at about 11% at the beginning of the month. Um, uh, I would say, if you look at the company narratives, if you look at, the Nielsen data, where you've started to see rural uptick happening, moderating inflation is definitely helping the cause.
Right.
What is the impact of this kind of monsoon? And we are still to end the month, but, we can only know for certain with a lag. But if you look at the historical data, it's interesting that there is no material correlation between FMCG volume growth rates and the monsoon data also. So,
Right. Yeah.
there are other factors at play as well. I think for now, we would work with a gradual rural recovery in terms of volumes. And, and yes, election related spending, how locals, how state governments spend, etc., also needs to be seen.
Right.
If that comes through, I think it could be a positive, supporter for the consumption.
Right.
But yeah, a place to keep an eye on. It's not very clear. It could be a little volatile, and hence we are building in a slow recovery as far as rural growth rates are concerned.
Right. And I take that urban demand has been relatively stronger as compared to rural demand. How are you viewing that going forward? Is that going to continue to support overall demand?
So let me split, urban demand into two buckets. So, on the staples side, as you correctly pointed out, the FMCG demand has been relatively better. It's been
Right.
more resilient. The urban FMCG demand growth rates have been trending ahead of rural
Right.
for quite some time, and that seems to be holding out. But when you look at the urban discretionary demand, that's got a mixed, behavior, and much of the segments like QSR, durables, fashion, all these categories have seen an impact, on urban demand due to the inflationary pressures.
Right.
We are kind of lapping one full year of that now, and starting December quarter, we have to watch out if there are any green shoots there. We also have a festive season, which is later this year, mid-October to mid-November. And, we are hopeful, it really is good so that it supports the urban discretionary demand to come up. But nevertheless, you will have a benign base. So growth rates in starting December quarter should start looking better,
Right.
for most of these segments in our view.
Right.
On the other hand, we have, segments like organized jewelry, or we have segments like paints, where growth rates have been fairly good in the recent past. We think, of course, the paint demand could have got impacted due to a very rainy, July month. But clearly, a long festive typically helps paint demand. So there's going to be a bit of volatility where we could have, a little bit of a soft quarter and then a strong quarter,
Right.
and the base effects also matter. But that segment is benefiting from a strong B2B demand, a good real estate recovery as well. So that segment could do relatively better on a full year basis.
Right.
And similarly, on the organized jewelry side, I think the share gains from the informal market continue. And there are very proactive initiatives from the companies also, both
Right.
on product distribution, which can still allow those companies to grow at a faster pace, within the overall discretionary basket.
Right. A fun question then on the discretionary basket. You cover a gamut of subsegments in the discretionary area, but I want your view on valuations. Do they seem expensive at the moment? And if they are, how soon are we expecting earnings to catch up?
Okay, so if you look at the valuations, I think the staples pack, by and large, we are now kind of trending in line with historical averages. And I think when you look at relative valuations to the market, we are probably even below historical averages.
Right.
But for the discretionary pack also, the trend is similar. Valuations are still not, I would say, cheap, but
Right.
I guess, they have come down from from the earlier levels. Earnings downgrade cycle for staples, I think, is slowly coming to an end in our view. If you look at last couple of quarters, you will see every quarter the quantum of earnings downgrades, earnings cuts is actually reducing in the sector. You can never say never, but we think that the earnings downgrade, at least the staples, is kind of coming to an end, and hopefully that should start providing some bit of support to valuations for staples. So our at a strategy level also for JP Morgan in India, our call is that at least in the near term, our preference is for staples over discretionary, given how the risk reward is really playing out.
Right. Well, fair enough. Latika Chopra, thank you so much. It was a pleasure
Thank you,
speaking with
Adam.
you. Thank you so much for taking us through your views. And that is all we have for this particular view. And well, we will be right back. Lots more lined up. Stay tuned to BQ Prime.